there, welcome back. Thanks so much for still staying tuned to The Money Show. You're watching ET Now. Now, there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we still have Shweta Rajani with us on board. Also, viewers, do not forget to send us your portfolio queries on our WhatsApp number 865-797-4571 or email us your queries on themoneyshow@etnow.tv. But with that, let's kickstart with all the queries you've sent us. And Shweta, I'm going to throw the first query your way. And this is coming from our viewer Nagraj, who's from Bangalore. He says that he's presently invested in the Quant FlexiCap Fund and the Parak Parik FlexiCap Fund. Could you advise if he should add the JM Financial FlexiCap Fund as well, or are there any other better funds? He has exposure to other categories of mutual funds as well, and his query is specifically about the FlexiCap Fund. For some more context, he's a long-term investor focused on wealth creation. Could you advise him over here? What's your advice?
Hi, Nagraj. So, a pointed answer to your question would be if you have two FlexiCap funds, I don't see the need for you to add the third JM FlexiCap fund. Just to give you some additional data points over here, if you look at different categories, right? FlexiCap is generally 75% invested in large, and you'll also have categories like multi-cap, contra, flex, dividend yield, large and mid, which also would have a large cap orientation, and they are more better in terms of their alpha potential. So you should not have more than one or two funds in each category and look at other categories. I can recommend you some funds, you can go in for a Kotak multi-cap, SBI large and mid, Quant active if you want in your portfolio, but two FlexiCap funds are good enough.
All right, well, thanks for that. Let's move on then. And the second query coming your way is from our viewer Hemant. He wants to invest in an ALSS tax-saving mutual fund and he needs guidance on that. He says, please let me know which ALSS mutual fund is good and also whether SIP or lump sum investment is the way to go. Help him out over here, Shweta. What's your take?
Hi, Hemant. You're looking for an ALSS scheme, and as the name goes, it is an equity-linked savings scheme, which not only gives you exposure to equity, but it also gives you the advantage of tax exemption under Section 80C, up to 1,50,000 of investment. These funds have a 3-year lock-in, right? So therefore, my recommendation to you would be that if you have the lump sum money, then you go ahead and invest as lump sum, because whatever you're doing today will be locked in for the next 3 years. If you're doing an SIP, your last unit that has gone in should have also completed 3 years. So doing a lump sum in an ELSS scheme would be a better option if you have the money. My scheme recommendation to you would be to go in for a Quant tax saver fund. That scores well among various parameters of return, risk, fund management team. So that's my recommendation to you, a Quant tax saver.
All right, Shweta, thanks so much for that. Let's move on and talk about the third query for the day, and that's coming from our viewer Vinod. He plans to invest in the SBI Large and Mid-Cap Fund and the SBI Hybrid Aggressive Fund. He's asking your view if these funds are good options to invest in. What's your view over here?
Yes. So, the SBI Large and Mid-Cap Fund is a good fund in the category, and you can continue with that investment. Talking about the aggressive hybrid fund, what an aggressive hybrid fund does is it's a combination of equity and debt. You could have 60 to 80% or a little more than that invested in equity and the rest in debt. Now, if I'm just doing a return comparison, let's say the aggressive hybrid in the last 1 year would have given you a 25% return, whereas an SBI large and mid would have given you a 35% return because it's been a year of equity doing very well. What I would suggest to you is not to go for the aggressive hybrid fund. You can rather have a separate equity and debt in your portfolio. So your asset mix, something that suits your overall strategy should be the aim. And you may not want to have 20% debt, but a little more than that, little less than that. Once you've decided that, have a pure equity like an SBI large and a pure debt fund in your portfolio. So, some of the funds that you can look for apart from this is you can go in for an HDFC Focus 30 or a Quant Active as your second choice of a pure equity fund.
All right, let's move on then and talk about the fourth query for the day, and that's coming from our viewer Ankur Pandya. Now, Ankur is saying that he has a sizable investment in pure equity and equity mutual fund schemes, and he is experienced. He has experienced good growth and appreciation over the last 10 years. He currently has idle funds, but he does not wish to take exposure in these highly overpriced funds at the moment. Instead, he prefers to go with a lower risk with a time horizon of more than 3 to 5 years. How would it be to take exposure in balance advantage funds at the moment? Is it the right thing to do? That's his question coming in. Shweta, over here, help him out.
Sure. So, since you have a 3 to 5 year of investment horizon, I would say rather than going for a balance advantage, because balance advantage again is doing a equity debt combination depending on the fund manager's, view on where the market could go. But that asset mix, he may choose to have a 60 equity, 40 debt in the balance advantage fund, whereas depending on what your goals are, you may want to have a 70 equity or a 80 equity on your portfolio. So again, rather than going in for a balance advantage, it may be better that you decide your asset allocation and go in for a pure equity and a pure debt fund. Uh, of course, debt, I understand that in the new tax regime would, have a higher taxation. So you can go in for an arbitrage fund as an alternative. So you can go in for an SBI or a Kotak arbitrage fund to fulfill the debt requirement that you have. The pure equities, since you have a 3 5 year horizon, I would say you can again, build it across 3 4 funds, uh, which could be a blend of growth style as well as a value style. So you don't have to worry about whether markets are expensive. You're building in a portfolio which is well diversified. So some of the schemes, that I would suggest you go in for, you can go in for ICICI Pru Large and Mid DSP Equity Opportunities, Quant Value, and Kotak Multi-Cap. So for funds, build your portfolio. It's spread out in terms of market caps. It's spread out in terms of different styles. So, from a 3 5 year perspective, I think, this would be a good combination.
All right, viewers, that was the last query that we were able to accommodate on this edition of The Money Show. Shweta, so thank you so much for taking the time out, joining us today and helping our viewers with the first topic about navigating the whole burden of a child's education abroad and in India, and how you navigate that and make it not a burden for you anymore. And also the second half of the show where you candidly answered all the viewers' queries. With that, Shweta, we'll let you go. But viewers, with that, it's a wrap on this edition of The Money Show. Thanks so much for watching.